Presentation of Wall Street Week is brought to you in part on behalf of Steinrow Mutual Funds, where a world of investment opportunities awaits you. Whether your investment goals are capital preservation, tax-free income, or long-term growth, the Steinrow family of commission-free mutual funds is ready to help.
Wall Street Week with Louis Rukeyser. Brought to you by public television stations. By CSX, the company that puts things in motion. Transportation, energy, properties, and technology. And by Prudential Beige Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. Produced Friday, April 7. Our panelists are Greta Marshall, Carter Randall, and Martin Zweig. Tonight's special guest is Michael Metz, Managing Director, Oppenheimer & Company, Incorporated.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the opening week of the baseball season, and we quickly found out why the sport ranks right up there alongside sex, money, and guilt as the authentic national pastime. The mood was set, as these things should be, by the President of the United States, who used to be a pretty fair country first baseman, even if he did insist on batting right-handed, presumably for political reasons. Not only did Bush have a lovely outing at Baltimore's Memorial Stadium, but he brought with him an understandably baffled President of Egypt, Hosni Mubarak, thereby setting off rumors that the next expansion team will be in the Gaza Strip. The man who once would have decided such things, former baseball commissioner Peter Ueberroth, was otherwise occupied, heading the team that agreed to buy Eastern Airlines for $464 million. He appeared to have the enthusiastic support of most of the airline's union members, who claimed from their bleacher seats that the present owner of the technically bankrupt line, Frank Lorenzo, was all errors and no hits. The exact odds on Ueberroth making an attractive airline out of Eastern were not known, Pete Rose having declined all interviews. Take me out to the ball game was also the theme in the job market, where U.S. employment hit another home run, the lowest unemployment rate since 1973, and the highest percentage of the population at work ever. Talk about your crackerjacks. But while the job situation continued to defy the gloomy preseason forecasts, much of the rest of the economy seemed to be caught in Alan Greenspan's carefully planned squeeze play. With short-term interest rates up by 3 full percentage points in the past year, there were widespread signs that growth was slowing, just as the Federal Reserve intended. Construction spending showed its weakest gain since August. Big retailers said their customers definitely seemed to be reducing spending, and U.S. domestic car sales slid on their bellies in late March. In fact, things are so tough in Detroit that Chrysler chairman Lee Iacocca, who, as the nation's most successful welfare client, earned about $21 million in 1986 and $18 million in 1987, was virtually put out on waivers last year, earning a mere $3.7 million. It just may not be the Tigers' year. In fact, if this sort of thing keeps up, it may be time for another taxpayer guarantee. And finally, the diamond theme extended to common stocks, as the Dow Jones Industrial Average completed an unusual triple play, finishing at its high for the week, down to the last decimal point on 3 different days. How about that? We tonight will talk with a man who has one of the best financial batting averages in Wall Street. But first, let's see how the usual set of bums made out. And as indicated, the Dow Jones Industrial Average closed Monday, Wednesday, and Friday at precisely the same point, suggesting at best the need for extra innings. Investors couldn't decide whether they were more pleased that growth was slowing or more worried that inflation so far isn't. And so the Dow held on to its week-long gain of just over 11 points at 2304.80. And the broader market seemed even more enthusiastic, with the over-the-counter index leading the way to its highest close since the 1987 crash. Even our elves are cheering up, taking their technical market index back to totally neutral for the first time since their sell signal 8 weeks ago. But I hope you loaded up on frankincense and myrrh rather than gold, because its long languishing price was down for the 4th week in a row. As the gold market resolutely refused to confirm the inflation worries, and as an international attack led by us stopped the dollar's rise, the financial baseball game had one last substitution. Madonna was benched by Pepsi-Cola, and not for a song. Marty Zweig, this market doesn't seem to know which way it wants to go.
It's a tough market. I think there's things pulling in both directions, and that's why. Up until the last week or two, interest rates were holding the market down. There has been some improvement in that area. But the bullish prop, I think, are all the takeovers that have been going on. There's a lot of money out there taking over a lot of companies, and it's really buoyed the market, and it makes it difficult to get it down.
Marty, you follow monetary matters very closely. With interest rates at this level, how good a market can we have in stocks?
You can have a good market with rates at any level. It's the direction of the rates more than the level. If rates were to stay level here for, say, 6 or 9 months, I think the market could go up. If rates go up another 2 or 3 percentage points in the next few months, you'll have trouble.
Do you have any estimate as to where they're going to
go? No. I really don't.
Last time you were here, you told us that while the monetary conditions were unfavorable, that the amount of pessimism around was relatively favorable. Is that still true?
There's a little less pessimism now than there was then, but there's still cash on the sidelines. Mutual funds have some decent cash, although less than when I was here last. The same with institutions.
What would be the best thing for this market, a cut in an interest rate?
Oh, yes, a slowing in the economy and a drop in interest rates, and I think the market could take off, but I'm not saying that's going to happen.
Carter Randall, do you think it's significant that this market couldn't be driven down any further?
Yeah, I do, Lou. I think the market is probably statistically cheap if you look at more than just the next few months. After all, the earnings that I see, the dividend increases that I see are coming along very, very nicely. Whether we're going to have a slowdown in the economy over the next few months or not is sort of a moot question, but if you look at it 3 to 5 years from now, I can see much higher nominal earnings and dividends, and therefore much higher stock prices than we have now.
Carter, you said the market was relatively cheap. I've seen opinion on all sides of that question. Somebody this week argued that compared to book value of stocks, it was not cheap. What's your view on that?
I don't pay much attention to book value, if you really want to know the truth.
What do you pay attention to?
Earnings. It's the only really important thing. It's on at 10.5 times last year's earnings, 9.5 times this. I call that cheap. In this century, they've sold at an average of 14 times, and this is well below that. When the market was at this level a couple years ago, earnings were much lower than they are now. So I'm looking at a cheap market. It's just that nobody wants to buy at the moment, and maybe that's just the time to do it.
Greta Marshall, Marty says that the market is in tension between two competing forces. Carter says probably a pretty good time to buy. What do you think?
We look at the long term always, and once again, we say that the market looks reasonably valued here, and so people should have their normal exposure to equities. I happen to think at this
point... What part is exposed in the normal exposure?
Normal exposure for most individuals would be a very large component, maybe up to 75% in equities if they're young and investing for the long term. And as people approach retirement age, obviously that would be reduced to maybe 25% as a normal component for equities as you get close to the time when you may need income.
Well, tell us how you operate that. If this is a normal exposure, what would induce you to have a less than normal? What would induce you to have a greater than normal?
Only on very rare occasions. And I can think of only about 1 or 2 times in the last 10 or 15 years when I would have taken a strong position one way or the other, that equities look so cheap that you had to buy them, or as in early '87, which was quite early before the market peaked, where they looked as they had been going up so rapidly that it was a time to at least cut back.
How do you feel on this valuation question? Do you think stocks are cheap, fairly priced, expensive?
We think they're fairly priced. And once again, I think short term, we were looking more at the bond markets in here, thinking that there's some very attractive long-term rates that ought to be locked in.
All righty. In any event, panelists, it's time now to make sure that when this market does find a direction, our viewers' finances are heading the right way. Marty Zweig, Stanley Robbins of Quartzsite, Arizona, bought an insurance company annuity through his stockbroker. Now he's wondering if it's safe, and if so, whether he should buy more. He'd like to know how these insurance annuities work and what you think of their pros and cons.
Well, I think that they're safe. There's a guarantee that if you should die, you'll get at least your original investment back, which isn't too bad, although you don't want to die, I guess.
I'm with you on that.
Yeah. You can get a fixed annuity, which I don't particularly like because your money is locked in for, say, 10 years, or you can buy a variable annuity where you can have a choice of how the money's managed. Usually there's a choice of money managers or different styles. You could buy stocks or bonds or combinations. The other good thing about a variable annuity is that it's tax deferred, so that your interest, dividends, and gains all accumulate prior to your retirement, and you can compound at a higher rate. So I think the product is a good one as far as variable annuities are concerned.
All righty, Carter Randall, with the annual meeting season upon us, a number of viewers are curious as to whether there's really any point in returning the voting proxies that companies keep sending them. For example, John Elio of the Bronx, New York, and Arnold Lane of Lawrence, Kansas, both say they've never heard of a shareholder proposal winning over management. Mr. Elio asks, why are we, the shareholders, wrong 100% of the time, all the time, with all of the corporations? And Mr. Lane adds, is there really any point in the average shareholders bothering to vote his or her proxy?
Well, as a matter of fact, the shareholder is usually right because most of what he votes for is what the management has recommended. I suggest that people should exercise their franchise to vote. No question about that. I suggest that most of the time they should vote as management recommends, because if they don't have confidence in the management, they shouldn't own the stock in the first place. Now, on special items, maybe they, quote, lose, unquote, but their vote is heard, and the management does pay attention to how many people vote and why. Losing is not necessarily losing. They should vote anyway.
Not necessarily opponents.
That's right.
Shareholders and management.
Of course.
Greta Marshall, how would you respond to Dan Honig of Phoenix, Arizona, who writes me as follows? By all accounts, cholesterol has become our public enemy number one. One cannot turn on TV without being bombarded with health warnings about coconut and palm oils and hydrogenated oils causing high cholesterol. A great number of food companies, including the giants, are getting into the act of producing cholesterol-free foods. My question is, are there any pure plays among the many smaller companies entering this field that show signs of strong growth?
Well, I wasn't able to find any small companies. Clearly, there are several areas that you look at. The first one is the testing area. Less than half of the Americans have been tested. So if you could find the pure play in testing, well, I didn't find it. Secondly, there are really two ways to treat this or approach this problem. One's diet and the other's drugs. And, the diet area, you might look at general nutrition centers, which is a vitamin and mineral supplement. There may be some play there, but it's not pure. Shaklee was taken over, which was another mineral supplement taken over by the Japanese, a Japanese drug company recently. And the best plays, or the serious plays, are maybe the drug companies, where both Merck and Warner Lambert have drugs that treat cholesterol. The growth rate in those areas is 15 to 20%, and by 1992 it'll be 10% or more of those companies' earnings and profits.
Okay, as usual, no guarantees if they're dangerous to your financial health. But if you would like to live healthily in Fat City, this is the place to clean out your financial arteries and be sure you're getting the straight skinny. So cut down your calories and supplement your salaries by writing to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, let's take a look at the changing world of the little guy in Wall Street and see if it is really creating the loneliness of the small investor. One measure of his relatively reduced role is stock ownership. In 1968, individuals owned more than 82% of all U.S. stocks, with the institutional share under 18%. Individuals still own most of the stocks, but their share is down to 58.5% as the institutions, such as pension funds, banks, insurance companies, and mutual funds, have seen their portion more than double. The small investor really begins to look lonely when we look at the change in trading volume on the New York Stock Exchange. By 1968, institutions were already the major players, doing more than 42% of the trading as compared with 33.4% by individuals and about 24% by exchange members trading for their own accounts. Today, individuals do a mere 18.2% of the trading on the big board. Member trading is held about the same, but the institutions now account for a whopping 54.6% of each day's volume. Remember, though, that the total volume of trading is much higher than it was 20 years ago. And in other financial arenas, such as the American exchange and the over-the-counter market, individuals still account for more than 55% of the buying and selling. Stocks, though, have become a smaller portion of the average American's assets. In 1968, stocks accounted for nearly a third of all individual assets, followed by small business ownership, bank deposits, pension holdings, and government and corporate bonds. Now, stocks represent only 15.4% of the total. Deregulation of interest rates has helped make bank deposits the most popular choice. Pension funds, which of course hold a lot of stocks themselves, are right behind, followed by small business ownership and bonds. Will smart individuals increase or decrease their stock holdings over the next 20 years? For some advice to the not-so-lonely, let's go over now and meet tonight's special guest, Michael Metz. Mike, welcome back.
Thank you.
Pleasure to have you here again. Michael Metz is one of the world's leading proponents of the value approach to investing, which seeks authentic bargains rather than passing fads. And he gives exceptional value to viewers of this program, as he did when he appeared in the month before the 1987 crash. The longtime sage of Oppenheimer and Company told us then that it was time to emphasize preservation of capital, that he had reduced his own stock holdings from 100% to 60% in the previous 3 weeks, and that he was convinced, in his prescient words, that most stocks have seen their high for the cycle. And that was just part of the superb money-making advice he offered to us that night. Mike, I and millions of lucky viewers thank you. Let's see if you can make it 2 for 2 by telling us where our stock's heading now.
Well, I think conditions are extraordinarily favorable for the stock market. Valuations, as one of your panelists mentioned before, are probably fair. They're not too high, they're not too low. But conditions in the sense of the extraordinary underexposure of almost every category of investor to the market, for example, individuals among others, very low foreign ownership, the constant shrinkage of supply, the lack of new supply, I think this is a very favorable situation for the stock market.
You're saying that there's so much cash available to be put into stocks that the outlook is favorable. How about the point raised by Marty, though, which is that the monetary conditions are somewhat hostile still?
I disagree with that in the sense if you look at the past monetary conditions, they existed at a time when there was a constant increase in supply of stock. If you look at monetary conditions on a global basis, I think they're highly liquid and highly favorable for the stock market.
What does that mean, that there's enough cash around?
There's money supply growing throughout the world at an extraordinarily high rate.
Do you think we're heading for a recession in this country?
I don't have any idea. I think we're having a slowdown in growth, yes. I think you have to assume that we're not going to have a serious recession. If you think otherwise, I think you should go into cash and wait.
Well, suppose somebody listening tonight, watching us, says, Mike Metz was pretty smart when he said it was time to get out. Maybe he's smart now when he says it's time to get in. Where do I get in? What would you tell him?
Well, we are what you call value investors, in the sense that, unlike Carter, if you'll excuse me, I consider earnings perhaps the least important variable in determining what a stock is worth. We look at cash flow, the value of segments, the ability to collateralize assets. There are an enormous number of stocks which are very attractive for the entrepreneurial buyer. For example, I happen to think the technology group is very interesting. And to take a value approach, Data General, a company that you could never buy on an earnings basis, stocks around 15, books around 22, it's around 3 times cash flow, 40% of sales. They are not making any money, but a high net cash flow. I think it's a very attractive opportunity for an entrepreneurial buyer. I think you're going to see a whole wave of consolidations in the computer industry. I personally wouldn't buy IBM, but if I were going to speculate, I'd buy Data General. You have in the oil industry, I think you're seeing the beginning of a huge wave of takeovers in the oil industry. I don't think you buy a stock because it's going to be taken over. You buy a stock because on a business basis, it's undervalued. You take a company like Unocal. It's selling probably at the equivalent of about $3 a barrel of barrels of oil already discovered, largely domestic. I think it's extraordinarily underpriced. I think if it's not taken over, the stock will drift up. If it's taken over, I think you make a lot of money. I think the aerospace industry has a lot of opportunities. Overcapacity, overcapitalized, United Technology. Very good company, very well run, has earnings progression, has high cash flow. The segments, I think, are worth a lot more than the stock is selling at.
With our usual caveat that even Mike Metz can strike out once in a while, one of your hits last time was you said that Polaroid was a candidate for restructuring. That's certainly been one of the big recent stories. You were entirely correct. A, what do you think of that stock now? B, do you have any other candidates for restructuring to give us?
Well, in the case of Polaroid, I have no great conviction about it here. It's a marginally attractive situation, so I'll pass on that. But I think, well, I would say in the computer, Honeywell. Honeywell is a very interesting company in terms of cash flow, the value of segments. The management has been less than distinguished in the past, but I think it's a very attractive restructuring candidate. I think DuPont, if you really want to play it conservatively, DuPont is cheap on cash flow, it's cheap on earnings, it's cheap on the value of segments, and you have a management that's willing to restructure. With one caveat, if they do buy SmithKline and Beckman, I would sell DuPont. That's the rumor around.
Which areas would you avoid?
Well, the areas I don't like earnings momentum stocks. I never can buy a stock on the basis of an earnings forecast. So if you buy a stock on that basis, I'd say be very careful. But you have a unique phenomenon in the market today. You have an extreme compression of valuations. There are very few stocks that are extraordinarily overpriced or underpriced. So on a valuation basis, I don't find any extraordinarily dangerous stocks.
Since you've tweaked the noses of a couple of our panelists, we should give them a chance to respond, starting with Marty Zweig.
Mike, are there any stocks around that have large holdings of other stocks that might make them particularly attractive?
I can't think of any offhand. One that, of course, was a great story was Shaklee. There was a value stock. You would not buy it on earnings, but Shaklee used to sell around 20. The value of their 80% owned Japanese subsidiary in the marketplace was worth about 27, so you bought the domestic company for minus something. I can't think of any holdings at the moment.
Incidentally, like you don't tweak my nose, it's just two different ways of
right.
Picking securities, that's all. Many people nowadays are not in the stock market because of the bond market. Very good yields, and money market funds are enormous at the moment. For the average individual investor, how would you advise them as to their choice between bonds and stocks at the present time?
I think it depends on your risk aversion, your income stream, and so forth. I think medium-term treasury is extraordinarily attractive. I'd like to make one comment about the vulnerability of the stock market to interest rates. Most of your buyers in the American market are entrepreneurial, and to them, interest rates are not such a big factor unless they go up several hundred basis points. Moreover, if inflation is going to rise, if you think it's going to rise slowly in the future, now is the time as an entrepreneurial buyer to borrow your money and to buy assets. So a slight rise in inflation is not negative for present buyers in the market.
I agree.
Mike, I think you agree that the small capitalization stocks are undervalued now relative to the large capitalization stocks. Could you address that issue a little bit about that difference in valuation and talk about how the individual investor might participate?
Well, I think the individual investor has an opportunity not available to an institution that has to move large amounts of capital, because he can buy positions in very small companies, and it makes a difference in his portfolio. Our screens, our valuation work indicates the most radical undervaluation is in small capitalization areas. And there I think the small investor has an edge over others. Do your own homework. There's no magic to it. Just do a little balance sheet analysis, a little cash flow, try to figure out what the segments are worth, and see areas where there's already some restructuring or takeover activity.
Mike, some quick questions. First, you said medium-term bonds are attractive. What's medium-term?
I'd say 4 or 5 years out.
Why do you not want to go shorter or longer?
Because I don't have that much conviction about long-term rates, what's going to happen to them. And I think the compensation, if you go 4 or 5 years, is adequate, quite good. And the downside risk very slight.
Mike, you've written a lot about foreign takeovers of American companies. There were a record number last year. Do you expect that trend to continue? And is it good or bad for the country?
Well, I won't make any editorial comment, but I think it will continue and accelerate. I think the phenomenon in 1989, and I was wrong when I thought this would happen before, is I think the Japanese will take over an enormous number of American companies and facilities in America. For example, maybe a paper plant or something like that. By the way, I think the paper industry is extraordinarily attractive. There's a cyclical group where no one believes Wall Street's high estimates for 89 and 90, unlike Digital Equipment or IBM, which sell on an earnings basis. One of the strong factors in the market is I think no investor seriously takes our estimates for 1990 of up earnings. That's why I don't think these stocks are vulnerable.
Which paper stock do you like?
I like Boise Cascade, International Paper, I think Union Camp. All very attractive asset plays, very attractive investments.
How bullish are you? The Dow's at 2,300 now. What do you expect it to be and when?
I think the Dow will be at 2,600 sometime in June of this year. Of course, you know, in forecasting, they say there are those who don't know and those who don't know they don't know. I don't know, but I think conditions are extraordinarily favorable, and I think the market sell at 2,600 still not be overvalued.
Bob Farrell, the great Merrill Lynch technician, when he was here 6 weeks ago, said he thought that 27, 22 that we hit in 87 was going to be a barrier for a long time. Do you agree?
I disagree. I think this is based on the theory of stale supply. Those who bought at 2,700 will have to sell. I think those who bought at 2,700 because the market was going to 3,000 sold at 1,900 because of going to 1,000.
Thanks very much, Michael Metz. A lot of people hope you're as accurate on the upside as you were in warning us in September of 87 about the downside. Thanks to the panelists. Hope you'll be back with us again next week. Then we'll look beyond this year's taxes to next year's income and the economy in which we'll earn it. My guest will be a leading financial economist, David Weiss. He'll be giving us an up-to-the-minute forecast on inflation, jobs, interest rate, and taxes. So be with us for many happy returns. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been brought to you by public television stations. By CSX, the company that puts things in motion. Transportation, energy, properties, and technology. And by Prudential Bates Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. That's $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Wall Street Week with Louis Rukeyser transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.
The Chicago presentation of Wall Street Week is brought to you in part on behalf of Steinrow Mutual Funds, where a world of investment opportunities awaits you. Whether your investment goals are capital preservation, tax-free income, or long-term growth, the Steinrow family of commission-free mutual funds is ready to help.
A stunning victory for another Mayor Daley. That's the story we'll talk about next.
From the cliff dwellings of Mesa Verde in Colorado to ruins in the jungles of Central America and the monuments of Thebes, join us as archaeologist David Drew retraces the footsteps of 19th century explorers and the treasures they uncovered. The technology of the Mayans and the crafts of ancient Americans come to life in this Channel 11 series. Following the paths of the original treasure seekers, Footsteps returns you to a bygone era.
Footsteps premieres tonight at 9. Some people say kids have no rights.
You mean do kids have legal rights?
Yeah.
You bet they do. a lot of them, everywhere except this classroom.
Join us for Necessary Parties, the tale of one boy exercising his right to keep his family intact.
Your mother and I are getting a divorce.
What lawyer? I'm suing you, Mom. We're going to stop the divorce.
Now you're talking.
Keeping the Family Together, Saturday at 7.
Today's programming is made possible in part by United Airlines, bringing the nation's business together throughout the U.S. and 12 foreign lands. United. Come fly the friendly skies.
Hi, I'm Sarah. You're watching WTTW Chicago.